Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be discussing free cash flow yields and how they relate to valuation and how you can use the free cash flow yield to gauge whether a company is overpriced or not. So when it comes to investing in wonderful companies, that sort of strategy basically relies on three basic things that we're trying to do. One is to buy a wonderful company. Two is to not overpay. And three is to then do nothing. So just to hold the company. So buy a wonderful company, don't overpay for it, and then do nothing. So when it comes to not overpaying, one simple metric that we can use is the free cash flow yield of a company. And we can use the free cash flow yield to determine if the company is overpriced or not. Now, when calculating the free cash flow yield, we should never take a year's worth of free cash flows too seriously. So let's look at a company. Let's use Microsoft as an example. So we'll go to Microsoft, and let's look at Microsoft's free cash flow yield. So we can just look at the free cash flow, and what we can do is we can look at the annual numbers, and what we can do also is just average out, let's say, the last 3 years worth of free cash flows for Microsoft. So 2022 made $65.2 billion. 2021 it made $56.1 billion. And in 2020 it made $45.2 billion. So in total, we can say that on average over the last 3 years, Microsoft's free cash flows have been about $55.5 billion per year. Now, we average out the last 3 years because we never want to rely on 1 year's worth of free cash flows too much. We always want to rather than relying on just, let's say, 1 year's worth of free cash flows, we want to average out, let's say, the last 3 years to give us a better sustainable base of free cash flows. Because 1 year could be a little bit too much, it could be too high, it could be too low, not representative of the overall situation. So 3 years, I find, is usually a good number in terms of an average to take, especially when it comes to wonderful businesses. 5 years, you want to be getting too low of a number because if the company is growing very fast, if you're including 5 years ago, those free cash flows are going to probably not be extremely representative of the current situation. But 3 years I find works pretty well. The next number we need is the enterprise value for the company, which is basically the market capitalization plus the debt minus the cash. We have this sort of average sustainable free cash flows of the past 3 years. And what we're going to do is divide it by the current enterprise value for Microsoft, which is basically 1.87 trillion or 1,870 billion. So divided by 1,870. And that will give us then our free cash flow yield, which is 2.9% or about 3%. Meaning if we're buying Microsoft today, Microsoft is yielding to us 3% yield in terms of its sustainable free cash flows on its enterprise value. What we then do is we compare this number, this 3% yield. So if I open up Paint here, we're getting a 3% yield. What we got to compare this to is the yield on some lower risk investment like a AAA bond. So for AAA bonds, let's say right now are yielding 5%. Meaning we don't want to invest in a company that's yielding less than this number here, this 5%. This is a lower risk rate. So basically what we're looking for is for companies to yield greater than 5%. If a company yields greater than 5%, then we can say it's at least fairly priced. But when it's yielding less than the AAA bond yield, then typically speaking we would consider it to be most of the time to be overpriced. So that's a simple strategy that you can try and use and employ to quickly gain a sense of if a company is overvalued or undervalued. You can look at the free cash flow yield using the last 3 years worth of free cash flows, compare that to the enterprise value to get a free cash flow yield on the enterprise value. Then compare that to something like a AAA bond yield. If the AAA bond yield is, let's say, 5%, then you're going to want your stocks to be yielding in terms of free cash flow at least 5%. So keep that in mind. I hope this video was informative, and we'll catch you guys next time.